So what if you could buy a home, buy a rental, and plan for retirement all at the same time? You can, and the answer to this riddle is house hacking. Buy a duplex, a triplex, or a four-plex and live in one unit, and you're gonna check all these boxes and even more, and I've done this myself, and in this video I'm gonna share from my personal experiences and things that I've learned over 30 years as a lender. And if you're thinking about house hacking, your timing really couldn't be better. Fannie Mae dramatically slashed the minimum down payment on 2, 3, and 4 unit properties. So I really believe the golden age for house hacking has arrived. And this video is, I guess I apologize in advance, going to be on the long side, but I have a lot to cover. There's quite a few things I want to share, and I don't want to leave anything out. So if you really want to understand house hacking from someone who has been there and done that and got the t-shirt and then wore out the t-shirt and then tossed the t-shirt into the rag bin, you're in the right place. So make a cup of tea and settle in, I guess. So when I got started in mortgage lending, I was in my 20s. I was broker than broke, and I was a renter, and I wanted more for my financial future, but I was so clueless about money, but I was really lucky. I was learning a ton about money kind of by observing, being a lender, looking at my clients' finances, but I was also surrounded by a bunch of really smart, really successful people. And I noticed pretty quickly that all the people around me who are where I wanted to be someday financially own real estate. But how was I going to break into real estate investing with hardly any money? And the answer turned out to be house hacking. Although nobody called it house hacking back then. It didn't really have a name. I just bought my first duplex and moved into a unit in 1998. So I guess I'm kind of like an OG house hacker in some ways. But by moving into a multifamily property, I could buy with the low down payment that I needed to be able to get a foot in the, I guess, literal door. And then subsidizing my monthly payment with rent kept my overhead low, and it also helped me make better investments. I was able to buy better properties in better neighborhoods than I could have otherwise afforded if I was trying to buy a single family house. And then when I moved on from each duplex I bought, I kept them as rentals, and I still own them today. And all these years later, they're now part of my passive income retirement strategy. But I can also say from experience that this path is not all roses and sunshine and rainbows. There are some things to think about and pitfalls to avoid. But the today me, the one with all these gray hairs, is so grateful to the younger me for taking this road less traveled and house hacking. And I'm about to do my best in this video to share everything I wish someone told me as I was getting started. And I'll break down the pros and cons I learned from firsthand experience. And then I'm also going to put on my mortgage professional hat and cover all the financing details that you need to know, including this huge change to Fannie Mae guidelines. And as I get rolling, I want to take just a second to ask you to click the like and subscribe button to my channel and sign up for alerts so you don't miss any new posts. And if you're thinking about buying a home and you're looking for a lender, I really hope you'll reach out. I finance all kinds of residential property for anybody needing any kind of loan, but I get a special thrill out of helping fellow house hackers begin and travel the same journey that I started so many years ago. My contact information is in the caption below, and I can't tell you how much I would absolutely love to talk. So let's start with the many benefits that come from living in a plex. And the first and most obvious one is the rental income from your neighbors living in the other units in the building that you buy. Making the leap from renting to owning a home almost always comes with an increase to your housing expense, so a subsidy to your monthly payment is always a welcome thing. But as I'm recording this video, affordability is near all-time lows. So help with affordability isn't just a nice thing, it's almost a necessity. Let's say you can afford a payment of $4,600 and you want to buy a home in inner Southeast Portland, Oregon. That's my home market in the 97214 zip code. Right now, a $600,000 purchase price would be the very top end of your budget. And there are literally 0 single-family homes available in the 97214 zip code under $600,000. There isn't one. But this lovely Craftsman duplex is available. It's $995, and that feels way over budget. But if you subtract the market rents from the larger of the two units from the projected payment, the net cost to live in the building would be $4,629. And if your local rules allow it, short-term rentals may even be a path to bringing home even more income renting through Airbnb or VRBO. And I like that strategy because it gives you the added flexibility to carve out time for visiting friends and family to stay in other units in the building. Now, living in a multifamily property also comes with some really significant tax benefits. And I'm a mortgage lender and not a CPA, so you for sure want to consult with a tax professional to confirm what your tax benefits are going to be. They're obviously going to be idiosyncratic to your situation, but I am going to share a little bit from personal experience and the information that my CPA gave me. And at this point, I've seen thousands of tax returns as a lender as well, so I do know my way around some of these things. Now, buying a single family home, I want to kind of make a comparison for a second. Buying a single family home can come with some tax savings. If you're eligible to itemize on your income tax return, the mortgage interest that you pay and some or all of the property taxes that you pay might be added to your write-offs. But a lot of people don't itemize on their income tax returns and get no tax benefit from a single family purchase. But house hacking is different. The rented portion of your property becomes what's basically a small business, and you're going to report your income and expenses for this business that you're starting on a tax form called Schedule E. You'll write off a portion of your property taxes and your mortgage interest, even if you're not itemizing on that main part of your income tax return, even if you're not eligible. And on top of that, you can deduct all sorts of other things: homeowner's insurance, repairs, cleaning, utilities, gardening, literally any expense that you have for operating this rental business that you've started. I used to leave a bottle of wine and a little card on the kitchen counter as a housewarming present when a new tenant moved in, and I was able to write off those expenses for my property. And then on top of all the real expenses, this stuff that actually leaves your bank account, the checks that you write, the IRS also lets you write off a paper expense called depreciation. And it's a little bit weird to talk about depreciation in connection with a property that we hope is going to be appreciating, going up in value. And I have to say that when I first learned about depreciation, it almost felt like cheating, but it's not. It's just an exaggerated version of something that every business owner can do. If you put an asset, any asset, into business use, the IRS will let you write off the value spread out over time. And if you think about this, assets that you put into business use are different than other expenses. Let's say you start a bookkeeping business and you buy a laptop. Well, the laptop is something that you're going to use over and over and over again. It's not consumed like, say, a tank of gas that you burn up driving across town to meet with a client and have a meal, right? Those are expenses that are sort of gone. That laptop is something you're going to use over and over. And so the IRS just has rules that let you write off the capital that you invested, the cost of those types of assets over time. And it just so happens that as a house hacker, the asset that you're putting into business use is really huge and expensive. It's a building. So the depreciation tends to be a really healthy number. Now, land can't be depreciated, but every other part of a property can be. You can depreciate a building and building improvements over 27 and a half years. Land improvements, and that would be fences, sidewalks, landscaping, sheds, sprinkler systems, stuff like that, that gets written off over 15 years. And personal property gets depreciated too, over 5 years. And personal property will include appliances, even if they came with the building, as weird as that sounds, and anything else that you use for the rental business. So maybe you buy a laptop to do your own bookkeeping, or you buy some tools. That was actually exciting news for me that I could write off tools. Your CPA is going to help you divvy up the property into these different categories. They call it bifurcating the property and set up depreciation schedules. The other thing your CPA can help you do is to determine the percentage of each expense that you should claim. You're going to be living in a unit as your home, your house hacking, right? So you can't write off your share of the water bill, the garbage bill, the repairs, other expenses, and so on. My CPA actually suggested just keeping things really simple and writing off expenses proportionately to the number of units. I lived in duplexes, so I wrote off half of the various deductible expenses against the rent. But if you buy a four-plex, you might be able to write off 75% of the expenses. And if after deducting all of your actual expenses, the stuff you wrote checks for, and then that magical paper expense of depreciation, if you still show a profit, then that net profit is going to get added to your taxable income. But there's another small perk that you get if you have a taxable profit, and that's that you don't actually have to pay FICO taxes. The contribution that you make to Social Security and Medicaid contributions isn't applicable to rental income. Now, if the net number that you get after you take your rent and deduct all your expenses and depreciation is a loss, you'll want your CPA to help you figure out if you can deduct that loss from your other income, from income you earn from your job or whatever else you do, and have that reduce your tax bill. You can't always. Rental losses are considered passive by the IRS, and passive losses can't always be written off against earned income, the income that you earn from working. To give you an idea, I wanted to show you an example of how this looks in action in the real world. So here is my Schedule E from the year 2000. You remember the year 2000? Good old Y2K. Back then, I was living in my first duplex. And that year I collected $11,702 in rent from my neighbor upstairs. And I wrote off $8,137 of expenses for the building. That included advertising, insurance, interest on my home loan, repairs, taxes, of course, property taxes, utilities, and then there's this miscellaneous line item, and that was probably wine and cards. I really did do that, and I could write that off. And that left me with $3,565 of profit, but my depreciation was another $4,985. So the IRS actually saw a $1,420 loss. So depreciation and these other things really do feel magical. At least they do to me. Now, if the idea of a subsidized house payment sounds really great, but being a landlord doesn't sound as great, another possibility is to buy in partnership. Team up with friends or family member and buy a small multifamily property. This can be a great option for multi-generational living. Maybe mom wants to be close to you and the grandkids, but you still want to have your own private living spaces. A duplex could work really nicely. I actually right now have a couple of clients who are siblings looking for a home together, and a duplex could work really well for them to have their own separate living spaces. But you can also buy in partnership with someone who isn't going to live in the property with you. A friend or family member interested in going in on a property can co-sign on your loan or contribute to your down payment, or both, without moving in. And one version of this idea that I like, there are lots of ways this could be applied, but I like the idea of turning college housing into a family investment. If you buy a multifamily property in your college town, that could give you a place to live during school that'll defray your cost of housing. And then it also kind of gives you flexible part-time work as a property manager, collecting rents, making repairs, and so on. And your folks may have to co-sign because you're a student after all, but when you graduate and you move on, co-owning a rental in a college town could be a nice ongoing family investment, kind of a side effect of having house hacked while you were in college. But where some of the real magic is happening right now, because the affordability challenges at the moment are pretty huge, is when buying in partnership can make otherwise unattainable goals of home ownership possible. If you're struggling to find an affordable home, or it just feels like home ownership is completely out of reach, teaming up to buy a multifamily property with a friend or, a sibling like my other clients or whatever could be a key that really unlocks the door to home ownership, makes it possible. I work all over, but again, Portland, Oregon is my home market, so I'm going to use it as an example again. Let's say you want to buy a home in Portland and you have 5% to put down and you want to keep your payment below $1,800. The bad news is you just can't do that. That equates to a $210,000 house. And there are no $210,000 houses for sale in the market. Now, if you're open to living in a condo, there's a cute condo available for $200,000 that would put your payment at $1,863, and that's the total for the mortgage, taxes, insurance, HOA dues, and everything, which is pretty close, but still over $1,800, and it's a one-room condo. So instead, let's say you and a friend go in on this duplex. It's right in the same neighborhood. The total payment would be $3,512. And if you split that two ways, that means you're each paying $1,756 a month. And now you co-own a multifamily property that probably has a wider audience of potential buyers when you decide it's time to sell versus a studio condo. Now, if you're retiring or you're planning for retirement and downsizing to a multifamily property could really reduce your overhead. I kind of like to think of the rental income as being a potential replacement for some of your wages as you transition into retirement. And especially if you're selling another property and rolling equity into it with a big enough down payment, rent from the other units could more than pay for the roof over your head. You could really wind up living rent-free. One of my real estate broker friends is actually right now on the lookout for a multifamily property. She's really aiming, she says she's describing it as a Melrose Place, but for her and all her friends in retirement, which kind of sounds like fun. Kind of. Although, I don't know, I guess I never watched Melrose Place. Although it's been a lot of years since I've lived in any of my plexes, but I have to say, when I think forward to the future, it really does give me peace of mind to know that if circumstances dictate it, I could go full circle and move back into one of my duplexes and live rent-free, or I could provide affordable housing for a friend or a family member transitioning their housing or in need. So it really does give you some future possibilities. Now, I promised that I was going to share some words of caution and a few tips, and I'm going to do that. But first, I want to take a little detour into my official professional area of expertise and talk about financing. Buying multifamily property purely as an investment takes a lot of cash. And that was the dilemma that I faced when I was thinking about getting into real estate investing as a young person without a lot of capital. It generally takes 25% down at a minimum, sometimes more. And the interest rates and the loan costs for investment properties are also higher if you're buying as an investment. But if you make a Plex your home, the loan costs and the rates and the minimum down payments are all substantially lower. To qualify for the more favorable, what we in lending call owner-occupied terms, you have to meet two criteria. The boxes you have to check are you have to move into the property within 60 days of your closing date, and you have to live there for a year. After a year, you're free to move out or move on, even to your next 2 to 4 unit property if you want. And that's exactly what I did. I lived in my first duplex for about 3 years, and I lived in my second one for just about 18 months. Now, FHA, VA, and conventional loans all allow you to buy up to a 4-unit property, and owner occupying a unit significantly reduces the down payment that you have to pay. A veteran with sufficient VA home loan entitlement can actually buy a 2, 3, or 4-unit property with no money down. And VA loans are amazing in a whole bunch of ways, but the opportunity to house hack with no money down is very high on the list of amazing features that VA loans offer. I also work with a specialty program that's open to doctors, dentists, and veterinarians that requires no money down on a duplex up to $1 million or a duplex purchase with 5% down up to about a $1.3 million purchase price. But to be eligible, you have to be a medical resident, a fellow, teaching faculty, or a practicing doctor. So if you didn't serve in the military and you're not a doctor, dentist, or veterinarian, in the real world, or for most of us, I guess I should say, the lowest down payment option is going to be 3.5% down on an FHA loan. FHA loans are a great option for duplexes, but they do come with some gotchas, and I'll talk about these, that do not play well with 3 or 4 unit properties. Now, conventional loans used to require 15% down for duplex purchases and 20% down for a triplex or a four-plex. Freddie Mac has for a long time offered something that makes my phone ring. I definitely have people call me about this, a 5% down payment option on up to a 4-unit property, 2 to 4 units under this special program called Home Possible. And it sounds really great on paper, but there's a catch. To qualify, your income can't be more than 80% of the median income for the area where the property you want to buy is located. And if your income is low enough to qualify for Home Possible, it's almost certainly going to be too low to qualify for a loan that's big enough to buy a multifamily property. So buying a duplex with an FHA loan was for a lot of years the sweet spot for house hackers. But that changed in a huge way. As of November 18th, 2023, Fannie Mae rules require just 5% down on up to a 4-unit purchase, and there are no income limits like Freddie Mac's Home Possible program, and there are no gotchas like the ones that are built into FHA rules. Now, there are still cases when FHA is going to be the best option. At 3.5% down, FHA is still the lowest down payment option, unless you're a veterinarian, doctor, dentist. FHA loans are also super generous about less than perfect credit. So if your credit has some blemishes, FHA can be a great path. And FHA loans also allow much higher debt to income ratios than conventional loans do. And they allow sellers to pay a much larger credit towards your closing cost. FHA loans allow up to a 6% credit toward closing costs, 6% of the sales price. And if you're putting less than 10% down on a purchase, conventional loans limit that to 3%. So if you combine an FHA loan with a big enough seller credit, you may be able to buy with just 3.5% out of pocket, possibly even less if you qualify for a down payment assistance program. But FHA sets maximum loan limits by county, and some areas, those loan limits are really low, significantly lower than the limits for conventional loans, and that can be problematic when it comes to buying a multifamily property. But the hands down most important thing to know about house hacking with an FHA loan are the extra rules for 3 or 4 unit properties. Now, one of these isn't usually a showstopper. You need to show that you have the equivalent of 3 months of your new loan payment, and that's going to be the total mortgage, taxes, homeowner's insurance, mortgage insurance, all, the total monthly payment times 3 left over in savings after you close. And this money does have to be your own savings. FHA is very flexible about gift funds for most things. You can have a gift for your down payment, a gift for your closing costs from a family member, but gifts are not allowed for this 3 months of what are called reserves. But if you've got a little money in a 401k at work, or maybe you've got an IRA from an old job or something, there's a pretty good chance you have that particular box checked. But the other rule, the second rule, is a huge problem. It's called the self-sufficiency test. And you can think of this as a little side test that the property has to pass. So you have to qualify for the loan, but the property has to pass the self-sufficiency test. And to pass this test, 75% of the market rent from all the units in the building, including the one that you're going to be living in, so this is again on paper, 75% of the market rents have to equal or exceed your mortgage payment. And with 3.5% down, they won't. It just, the math just doesn't work. In a really, really affordable market, you may need to put maybe 10 to 15% down to pass the self-sufficiency test. But if you want to buy a nice building in a higher cost or coastal city, it could take 25%, 30% down or more. So 3.5% down on a 3 or 4 unit property. And again, this is just 3 or 4 unit properties, 3 or 4% down on a 3 or 4 unit property on an FHA loan pretty much only exists on paper. And FHA has one other gotcha, I guess, for people who want to be house hackers who might need a cosigner to qualify for a loan. FHA loan rules are really generous about allowing a family member or a really close friend to cosign on a loan. But if you add a non-occupying cosigner, someone who's cosigning but not living in the property with you, to your loan, and you want to buy a 2 to 4 unit property, the minimum down payment on an FHA loan jumps from that low 3.5% all the way up to 25%. But now that Fannie Mae allows 5% down, these issues for financing 3 and 4 unit properties are in the past. You can buy a 3 or 4 unit property with no need to pass the FHA impossible self-sufficiency test. And if you need a cosigner to qualify, cool, no problem. You can still buy with just 5% down. And removing these obstacles is such a game changer if you're hoping to house hack in a 3 or 4 unit property. The flexibility, however, to buy with a really low down payment does come with some added scrutiny. And I want to call this out. All the things that make house hacking so great also make lying about house hacking really tempting and something lenders have to worry about. I really hate to say it, but it is, there are some people who will lie about their plans to move into a property to get better loan terms. And it's far more prevalent than it should be, given that it is illegal. It's called occupancy fraud, and it's federally prosecutable, and it can lead to fines and even jail time. So needless to say, don't commit occupancy fraud. Don't do it. It's not worth it. Mortgage underwriters are, because it is more common than it should be, trained to be skeptics about occupancy. So you really shouldn't be offended if you have questions come up, if you've got to answer questions or you need to write a letter explaining your plans to move into a property. It really is just an underwriter doing their job. I firmly believe it is way better to answer these questions before they're asked. But even when you're on the up and up and you really plan to move in, you're going to house hack, there are situations when an underwriter may find it difficult to approve an owner-occupied loan. It has to make sense that you would be moving into a multi-unit property when looking at your housing situation and who you are relative to real estate in the big picture. And I'm going to use an example just to kind of illustrate this, because I spoke to someone last week who's a licensed real estate broker. He's a property manager, and he owns rental properties in multiple states, some himself, some in partnership with other people, including a duplex in the town where he lives already and wants to buy. And he and his family are living in a single family home that they also own. And he wants to move out of that home, rent it out, buy another duplex, and put 5% down using the new Fannie Mae rules. And I believe him. I think he really is going to move into the property, but I think it's going to be very hard to convince an underwriter. I've got a few ideas that he and I are going to talk about, but it's a challenging situation if you look at it from the outside looking in to say, yeah, it totally makes sense that he would move into that duplex, and he really is looking at it as his home and not a rental. Now, next I want to talk about the rules for using rental income to qualify for your loan. Rental income can usually, but not always, be used to boost the amount you can qualify to borrow. But the math doesn't really work out like you might think. When I lived in my duplexes, I ran my budget the way I suspect most people who are house hackers run their budgets. I collected rent from my tenant, and I applied that to my mortgage payment, subtracted it from my mortgage payment in effect, and I considered the net amount to be my house payment. Now, imagine a triplex. Let's say you live in a triplex and you have a $6,000 mortgage payment, and you have 2 other apartments that are rented at $1,500 a piece. $6,000 of mortgage minus that $3,000 of rent leaves you with a net cost of $3,000. But that's not how lenders run the numbers. Lending rules treat the whole $6,000 house payment as your house payment, and then they give a little boost to your income from the rent. If you're purchasing a property, the kind of standard loan rules allow 75% of the rent to get added to your income. And the 25% deduction that we take away is called a vacancy factor. And that's a stand-in for vacancy, but it's also all the other operating expenses, utilities and repairs and maintenance and gardening and, all that stuff. It's sort of a shorthand placeholder for that. So the amount of rent that's going to go into the formula, the 75% of something, depends on the situation with occupancy and current leases in the other units in the building. If a unit is vacant, or a unit's rented, but the rent can be increased on pretty short notice, relatively short notice, say a couple months, then lenders can use current market rent. 75% of current market rent can be added to your income. But if a unit's occupied and the renter is locked in on a lease, or there are laws, maybe local ordinances or laws that restrict increasing the rent in a short period of time, then the actual rents from the current leases times 75% might be what lenders are going to use to add to your income. And it's also worth knowing if a property has bigger and smaller or nicer and less nice units, lenders generally run their math assuming that you're going to move into the bigger, nicer unit. And this can be kind of aggravating. I've had lots of clients who are like, no, I'm totally going to live in the smaller unit. I want to, I'm a house hacker. I want to get as much rent as I can. But the math that lenders are going to run generally will assume you'll be living in the bigger unit. Now, the ramifications of all these rules that I just outlined make a big difference in loan qualifying. Applying rent to income instead of netting it from the mortgage payment has the result of making it tougher to qualify for a house hack. And most of my clients who are buying a single family home, when I say, hey, what do you want your mortgage payment to be? They don't want a mortgage payment that's nearly as high as the amount that I can qualify them to borrow. And that is not true for many, maybe even most of my house hacker clients. Many are perfectly comfortable with a house payment that pushes the limits of the amount that I could qualify them to borrow. And I want to kind of illustrate this with a little bit of an example. So let's go back to those earlier numbers as our example. And we'll just say you make $10,000 a month to keep the math simple. And you're going to buy that triplex that has the $6,000 mortgage payment. So a $6,000 mortgage payment minus the $3,000 of rent from the other two units leaves you paying $3,000 for your share of the mortgage payment. And $3,000 divided by your $10,000 of income leaves you at a 30% debt to income ratio. And that's not crazy. Keeping your house payment under a third of your income is probably right in line with the conservative home buying advice that you might get from like your granddad or Dave Ramsey or something. So you'd be in a really good place on a month-to-month budget kind of basis. But here's how the lenders' versions of this math work. Market rents for the other two units in the triplex are $3,000. We multiply that times 75%, and that leaves us with $2,250 of net rent. You make $10,000 of other income from work, add that $2,250, and we have $12,250 of total income. Divide your $6,000 mortgage payment on this triplex by that $12,250 of income, and we get a 49% front debt to income ratio. That's really high. Now, I've made a playlist about debt to income ratios, and you can check that out here if you want to know more. I'll put a link up there. But in general, just for the quick and dirty, FHA loans don't allow a front debt to income ratio any higher than 46.99, and Fannie Mae cuts us off at 49.99% for all debt. So that would be the house payment plus student loans, credit cards, car payments, etc. So that totally doable, no problem $6,000 monthly payment is actually a stretch in the lending world for mortgages. It might not even be feasible if you have much other debt. And as an aspiring house hacker, you really want to work with a lender who understands this dynamic and can kind of walk you through the math behind your own debt to income ratio. And I like doing this for all my clients, but really especially very important to do this for my house hacker clients because you need this information to shop efficiently. You don't want to waste time looking at properties that you can't qualify to buy, and you want to be able to quickly identify the properties that are viable and have a really good idea of what the market rents are going to have to be to make the numbers work, really understanding how all these numbers come together. And if you're feeling thwarted by this disconnect between what you can qualify to borrow and the higher prices that you can totally swing that would be fine budget-wise because of the rent, remember that those new Fannie Mae rules do allow a supportive family member, somebody who wants to help out, to co-sign while you're still putting as little as 5% down. Now, as I alluded to earlier, to use any rental income for loan qualifying, so before we can take that 75% and give your income a boost, there are a couple of extra considerations. So VA loan rules require that your lender make sure you're going to have what they call reasonable likelihood of success as a landlord. And one way to do this is to show that you have prior experience as a landlord. If you can show a couple previous years of Schedule E, you've collected rent on your personal income tax returns, then that checks that box. But if not, then if you want to count rental income as part of your qualifying income, you may have to hire a property management company to collect the rent for you. VA rules also require that you have 6 months of your new mortgage payment left over in savings after you close, kind of similar to that FHA rule for 3 and 4 unit properties. And Fannie Mae also has a weird requirement that can be a little bit of a gotcha for some people. Lenders can only include rental income for qualifying, again, that boost of 75% of rent to your income, if you have a current housing expense. If you already own a home or you're paying rent, normal situation, then you're fine, you're all set. But if you moved in with family to save up a down payment, or you're living rent-free with a partner or a spouse or a friend and you don't have a housing expense, then no housing expense means no rental income to qualify for your loan. So if you're living at home to save up a down payment and mom and dad are being cool and they're not charging you any rent, here's my advice. Start paying them something. The rules don't say how much you have to pay, just that you have to have a housing expense. So even $100 a month might be able to check that box and switch on rent as part of your qualifying income. And while you're doing that, do it in a way that's easy to track. Write checks, pay with Venmo, pay with Cash App in some way that it's going to be easy to document the rent for your loan. Now, as with any mortgage, your lender is going to order an appraisal from a licensed appraiser. And to learn more about the appraisal process, you can click this link above. I'll put another video up there, a longer one about appraisals. Duplexes, triplexes, and four-plexes, 2 to 4 unit properties, are all appraised on Form 1025. That's the small residential income property appraisal form. And this form is almost like a twofer. It's 2 appraisals in one. The appraiser searches for nearby similar properties that have sold recently. These are called comparables, or comps for short, and they adjust them, and using a certain methodology, develop an opinion of the market value of the property. And then in addition, they go searching for comparable rental properties, and they do something similar to come up with an idea of the market rent for the property. And this rent survey, as we usually call it, is where your lender is going to get the market rents that are used in your debt to income ratio, if market rents are being used in your debt to income ratio. Because again, there are circumstances and we have to use the actual leases. But be cautious when you're estimating market rents. The appraisal is often one of the last documents to roll into your loan file, and you really, really don't want your purchase to be derailed at the 11th hour because you were overly optimistic earlier about what the rents were going to be, and then the appraisal doesn't support that number and the numbers don't work anymore. And I hate to say it, but rent from an appraisal often will skew low. And this can make appraisers feel like the enemy, but the problem isn't with appraisers. They're not out to get us. It's the methodology that they're stuck using. They have to use whole buildings as rental comps. They can't use individual apartments. And this can be a little bit hard to conceptualize, so I'm just gonna give you an example. Let's imagine someone asked you, hey, what would this 1,000 square foot, 2-bedroom, 1-bathroom apartment in your neighborhood rent for? If you got that question, you'd probably go poke around online, maybe look at Zillow, other websites, and see what other apartments nearby seem to be renting for. You're probably not going to pay a lot of attention. You probably won't even notice if an apartment like the one that you want to rent out, where you're trying to figure out what the rent would be, is an apartment in a duplex, or it's one in a four-plex, or maybe it's in a 10-unit building. It just doesn't matter. And how much the other apartments in that building are rented for, the ones that aren't for rent right now, really doesn't matter. But appraisers aren't allowed to look at isolated apartments and cherry pick like that. When they're appraising a triplex, they can only consider the current actual rents from all 3 units in other whole 3-unit buildings. It's really weird. I actually tried calling in a favor from a friend who's a professional property manager. I had a client looking for a triplex, and I asked him to give me help finding good rent comps for this triplex that this client wanted to buy. And I explained what I needed, and his head just about exploded. He didn't even have a way to sort the properties he manages by the number of units in each building. He did want to help me out, but he had no way to help me out, even though he wanted to. So I want to shift gears now away from lending stuff, and as promised, share some, words of caution and tips and just stuff to consider before you dive into life as a house hacker. And some of these, speaking of life, are kind of lifestyle related. While house hacking in a multifamily property is a definite upgrade to your privacy relative to renting out a bunch of rooms to roommates in a single family house, you are still living in a shared situation. My first renter in the upstairs apartment in my first duplex was really into Alice in Chains, like really, really into Alice in Chains. Every morning, every night, really into Alice in Chains. And I have a vivid memory from my second duplex. I had just put food on my plate and was on my way to the table to eat dinner when there was a knock at the door. So there's this knock on my door. I answered, and I spent the next 15 minutes trying to politely extricate myself from a conversation about a very small maintenance issue that definitely wasn't an emergency, while literally holding my dinner on my dinner plate, talking to my neighbor upstairs. Speaking of maintenance, while you could always let a small repair slide around your own home until you have the time, money, or energy to work on whatever it is, you really can't do that when there's a problem in your tenant's space. And there may even be local ordinances requiring that you resolve maintenance issues within a certain time frame, so you have to plan and budget accordingly. In a sense, I think of house hacking like buying your home with a side order of side hustle as a property manager. And if you don't want the job, you can always hire a property manager, but you still need to communicate with the property manager. You have to manage the manager. And property managers usually charge 8 to 10% of the rent for their services, but for that, they're going to screen tenants, so hopefully you'll have someone doing a good job of making sure you've got good tenants who will pay. They'll collect the rent, they'll field, there aren't that many of these, by the way, but they'll field those late night maintenance phone calls for any kind of emergencies that come up. And then maybe most importantly of all, they'll shield you from the responsibility and the liability of keeping up on landlord-tenant laws and using proper leases and all the correct legal forms, providing correct notices to your tenants, and so on. If these lifestyle and property management considerations are making you think twice about house hacking, you could take a page out of another friend's book. She hired a property manager for the other unit in her duplex and didn't even tell her neighbor that she owned the building. She just loved staying anonymous as just another renter in the building. After a few years, she got more comfortable and confident and decided she wanted to save a few bucks by taking over managing, but it really gave her peace of mind initially to be just more anonymous and another tenant in the building, so to speak. Although hiring a property manager can insulate you from certain types of liability, you still have to think about managing other risks. You want to carry excellent and appropriate insurance and maybe get an umbrella policy. These policies can protect you from exposure if a mishap harms a tenant physically or harms their property. And if you're the type to wear a belt and suspenders at the same time, you may even want to form a limited liability company or LLC and move ownership of the property into it. If you run an LLC properly, it can act as a firewall between the building and your other assets if there is a problem, a disaster at some point, and you have any liability. Fannie Mae, by the way, allows ownership to be transferred to an LLC, the title to a property to be transferred to an LLC after closing, but FHA and VA loans don't allow that. Now, in most markets, another challenge is that the inventory of 2 to 4 unit properties for sale is going to be pretty limited. And this means you may have to be more patient, cast a wider net, and be more flexible about the areas and the spaces in which you're willing to live. Now, for me, this part of house hacking was kind of a fun adventure. I just rolled with it and I bought whatever and wherever a building I like popped up, and then I made the space work. And I thought it was great, but I was younger and I was footloose. If you have kids in a certain school district or really specific needs for your living space, a plex that checks all those right boxes, since there are already fewer of them to begin with, and now you have these needs, it really may be a needle that doesn't exist in a haystack. When you find a property that you like, you need to make sure it works as a house hack. Your lender needs proof that you can take occupancy within 60 days of closing. If there's already a vacant unit or a tenant's given notice and they're on the way out, you're all set. But if all the units are rented, you need a seller willing to give notice to a tenant, and they have to be able to give notice to a tenant. Back in my home market of Portland, Oregon again, landlord-tenant laws have gotten pretty strict and make this challenging. Landlords have to give a minimum of 90 days of notice and pay a relocation fee to tenants. So your seller, if the units are all occupied, has to be willing to give notice at least 30 days before your closing date, so you can move in 60 days after closing, and they have to be willing to write a check. And even if they're willing, landlords can only give a no-cause notice to tenants in a 1 or 2 unit property. So if you're looking at a 3 or 4 unit property and all the units are occupied, it may not be possible for the current owner to give notice to a tenant and make a house hack possible. Now, figuring all this out and negotiating all these terms can definitely get a little complicated. And of course, house hackers are looking for great multifamily properties, often in competition with real estate investors. And if you and a real estate investor make an offer on the same property, your offer could be at a little bit of a disadvantage. It could feel riskier or weaker if you're making a smaller down payment than an investor, because the investor has to make a bigger down payment. And it can definitely feel more complicated and less attractive if you're asking the seller to move a current renter out so that you can move in. So it's always important to have a really great real estate broker in your corner, but I think it's extra important when you're shopping for a house hack. A skilled agent in your area is going to know the local rules and can help you write an offer that's both going to be appealing to a seller, but also protect your interests. And then they can also help you do due diligence. You want to make sure you get copies of all the current leases, because again, we need to figure out what the status of them are for lending purposes and whether or not we can use market rents or we have to use leases as the income for loan qualifying. And then you want to get records on how reliably the existing tenants that you're inheriting with the building are at paying rent on time. Are you inheriting a problem? Are you inheriting folks that pay like clockwork? I also recommend finding out if your seller has leased anything. Sometimes laundry machines are leased, or are there any other agreements that the seller signed that are going to become your obligation once you own the property? And see if you can get copies of the seller's past couple years of Schedule E filings. You can use those to get a little bit of insight into how well the property's been performing as a rental and how much the utilities and some of those other expenses, maintenance and other ongoing expenses have been running. And you can also use it to kind of get a feel for how on top of the repairs and maintenance and updates the seller has been over the past couple of years. That said, a little deferred maintenance and wear and tear from prior renters is pretty much par for the course. It's kind of to be expected. It's pretty rare that someone is going to list and sell their perfectly maintained pride and joy of a property with absolutely nothing wrong with it. So if you find yourself interested in a property that needs some upgrades and you want to tackle them right away, a renovation loan could be the answer. FHA, VA, and Fannie Mae offer loans that allow you to finance improvements in with and at the same time as and with the same loan that you use to purchase a property. Now, these are more complex and costly loans and they take longer to close, but they can be an amazing way to add value. I've had a client add a ton of value to a duplex that she purchased using a renovation loan. And If you find a seller with a fixer-upper that's been sitting on the market for a while, they could be really happy to work with you and okay with the longer timelines that it takes to close them. Some of the most amazing house hack success stories that I've seen have been buying in partnership. I brought that up before. In one case, two people who had never even met each other before, they worked in the same school district, and that was it, bought a duplex, bought a duplex together, and it worked out great. But I've also seen some cautionary tales, and I know of at least one friendship that completely fell apart over co-ownership of a duplex. Any partnership you go into requires trust and planning around the long and the short-term consequences of co-owning this property. And it's important to understand that even though a multifamily property has multiple living spaces and separate addresses, it's legally one thing. So that means you and your co-owner can't buy or sell or finance, take out a loan without working together, and you'll be jointly liable for one mortgage. Your finances and your mortgage payment history are going to be tied to each other. So before you buy, create protocols for decision-making and sharing costs, both for the day-to-day expenses and for repairs and any improvements that you want to make over the years. And at the very least, talk these things through with you and your partner. But better yet, I think it's a good idea to hire an attorney or a mediator to facilitate the conversation. They can prompt you with a lot of the what-if questions that you might not have thought about, and maybe even draft a formal partnership agreement. Thinking about exit strategies is extra important. I've owned my plexes for decades, but you and your partner may not always want to live in or co-own the property that you buy. So think about that. One of you could buy the other one out, or you could agree to sell and split the profits, but you want to have a strategy and a plan. And another lesser known strategy when it comes to this exit strategy is to convert a multifamily property into condominiums. Now, local rules are going to apply, and there can be some restrictions on what's possible, so I don't want to speak too broadly. But if it's possible, the condo conversion process splits this property that's been one thing into separate legal units that you can now own and transfer and sell and finance and will to heirs and everything separately from one another. You're also going to be creating a homeowners association, and you and your partners will be members in that. Because your property is a hybrid when you're house hacking, it's a hybrid of a home and an investment property, it's going to have a hybrid status when you sell it. The part you live in is going to be treated like a home, and it's going to be eligible for the same capital gains tax, what's called capital gains tax exclusion, that a single family residence would have. You can walk away with up to $250,000 of profit tax-free if you're filing single, or $500,000 of profit if you're married and filing jointly. But the portion of your property that was rented out is going to act like a rental. And that means you have to pay tax on the profit, what's called capital gains tax. This tax that you owe will also include a recapture of all of that magical depreciation that you claimed over the years. And I've had some people ask, well, gosh, maybe I just don't claim it because I'm going to have to pay tax on it later. But believe it or not, you have to pay the recapture even if you don't claim any depreciation over the years. So definitely claim your depreciation. And if you got caught up in that pesky passive loss limitation that I mentioned before, where you had losses that you weren't able to write off against your earned income, now's your chance to benefit from all those losses that accrued over earlier years. The accrued losses, when you sell, are unlocked and can offset your capital gain and reduce your taxes due. And the rented portion of your property can also be eligible for something called a 1031 exchange. A 1031 exchange allows you to roll the proceeds from the sale of one investment property into the purchase of another investment property and completely defer, if you follow the rules, completely defer paying taxes on the profit. The keys to maximizing your tax benefits while you own and limiting your tax liability when you sell are planning and record keeping. Strategize with your CPA or another tax professional to create a plan and set up a system to maximize the tax benefits from your purchase date through to your sale date, maybe even past your sale date if you do a 1031 exchange. And if you're really into the long game, you may even be able to maximize tax benefits by bouncing around your building and living in more than one unit at a time over the years. I guess maybe not at a time, but talk to your CPA and strategize. When you finance a plex, you can expect to pay some extra costs. Additional loan costs are applicable. For FHA and VA loans, the added costs are limited to just a little more expensive appraisal fees. I mentioned the appraisal is kind of a two-for report, 2-in-1, with the report on the market value and the report on the market rents. And there are fewer multifamily listings that appraisers have to choose from. So they typically have to put in a little more work into building a cohesive appraisal report. So you can expect to pay a few $100s more for your appraisal. In addition to a higher appraisal fee, conventional loans also include higher loan level pricing adjustments for 2 to 4 unit properties. LLPAs are risk premiums that Fannie Mae and Freddie Mac charge based on your loan profile. They're a one-time fee paid at closing as a percent of your loan amount. And I want to emphasize that they're not an addition to your interest rate. They're an addition to your closing costs. I made a video all about LLPAs, highlighting a couple of loopholes you can use to avoid them. I'll link it above. If you're not eligible for one of those loopholes, then the premium that you'll pay for buying a 2 to 4 unit property with less than 25% down is 0.625% of your loan amount. And again, that's a one-time cost, so it would be $625 per $100,000 that you borrow. On a $500,000 loan amount, that cost would be $3,125. The cost drops to 0.375% of your loan amount if you put 25% to 40% down. So that's $375 per $100,000 of loan amount that you borrow, or $1,875 on a $500,000 loan amount. And if you put at least 40% down, then the LLPA drops to zero. There's no additional charge because you're buying a 2 to 4 unit property. Now, my point of view is probably pretty obvious. There are some complications and costs, and house hacking is a bit of a lifestyle choice. It calls for some extra planning, and it can involve some compromise and a little delayed gratification. But if I had it to do all over again, I would absolutely dive headlong into house hacking without hesitation. If anything I've talked about has captured your imagination, I would love to talk and help you plan for your house hacking journey ahead. Use the link in the caption to schedule a call. I look forward to talking, and thanks for watching.